have a big video for you guys today. I have a big video. I'm saying we. But this video is going to reveal every single holding in my portfolio, every single stock, ETF, whatever it is, I'm putting it out there. I want to be transparent with you guys because I think that's the best thing to do when you're, you know, putting forth advice, giving your opinions, is to be transparent because that's going to be the real truth of, what you preach. And so I always emphasize on having a diversified portfolio in quality stocks. And so we're going to see if that really rings true and has done good for me. I also always say, never have one company be more than 10% of your portfolio. We're going to see if I stuck to that or not. So we're going to reveal two stocks at a time just because I think I have about 25 holdings total. And so I want to be able to get through this in a somewhat quick fashion. But we're going to cover the name of the stock, the ticker symbol. We're going to cover what sector it's in, the gain or loss in dollars, and then the gain and loss in percentage, and then the percentage of my portfolio that individual holding has. Again, never want to have more than 10%. We'll see if that's true for all of them. So I'm going to be revealing my diversified portfolio, and these are quality stocks. Now I have made a few sells this year in stocks that I got into for the wrong reasons, and there may be some stocks in here I might briefly mention that I might sell out eventually, but overall I think I have a very well diversified portfolio in good quality stocks or well known and rated ETFs. So I'm really excited to share this with you guys today. This is a big thing for me because I started this journey 2 years ago investing, and this is something that I'm really proud of. And I really, try to encourage everybody to start investing, saving your money. You know, I've talked to many people lately, and the thing is, you can choose to either put your money in a savings account where it's going to lose value because of inflation, or you could put it into the stock market where these companies are working hard to grow their revenue, their earnings, their profit, expand, be innovative. So your money is working hard for you, right? I always say, don't work hard for your money, let your money work hard for you. So I do focus mainly on dividend stocks, but I do have some growth stocks. So after we reveal each individual holding, I'm going to reveal the total performance of my portfolio. And then after that, we're going to look at a few charts that I put together and then get into, I think what's very, going to be very exciting is the dividends that I've earned this year compared to last year and the total, and let you guys just look at it all. I'm being very transparent here, so I'd appreciate it if you guys subscribe to my channel. It's always good to get a different opinion and get different advice, get a different view. It's a very healthy thing to do, and it's something I do myself. I'm subscribed to many different channels to get that broad range and perspective, and then also obviously mainly implement that into my head and do my own research and then put it out there. So with that said, let's stop chit-chatting. Let's get into this video. Let's start with the first two stocks. So right here, you'll notice I have good old 3M. Now 3M is in the industrial sector. This one has done very well for me. I've made $156.38. It's grown 14.39%, and it makes up about 3.78% of my portfolio. This one's mainly held for the dividends. It pays a really good dividend, and I think it has a bright future. You see 3M everywhere in Home Depot, around your house. This is a company I've done a video on, so feel free to go through my channel and look at it, but I will remain holding this one throughout 2022. The next one is a controversial one. It's AT&T. It's in the telecommunications sector. Now, this is one of just a few that I have a loss on. I have lost $317.40. I'm down 17.7%. Ouch. And it's about 4.5% of my portfolio. It makes up 4.5%. Now, I did a video very recently. I really encourage you guys to watch it. I am holding this company for a few reasons, and I'm a little bit bullish on this company now, but I think it's a smart thing to hold on this company at least over the next couple years. And if you're curious why, check out that video. It's a very good video, and I think it'll really help you if you're an AT&T holder. So these are the first two stocks. The next two, you'll see Bank of America. It's in the financial sector. This one is my top performer, but I don't have a ton of money into it. I wish I would have put more in, but so far it's made me $500.04 in gains. That's a 71.31% growth. That's amazing, fantastic. Bank of America has just really outperformed for me. It makes up 3.65% of my portfolio, and this is just, a very well established financial institution, a bank that many, many people, but mainly corporations use on, for their businesses. And so I'm a long-term holder of this one, no plans of getting out of this. Then we have Cisco. Cisco is in the technology sector. This one has done very well for me. I've made $476.52. It's up 51.93%, and it makes up 4.24% of my portfolio. Cisco is a turnaround play for me. It's done very well, but they're getting more into the cloud-based area. So I really think this is a stock that has been a steady stock for a long time, but I think it'll turn into a growth stock long term. So I'm very bullish, and I will be holding this one. The next two stocks are good old Coca-Cola, one of the most well-known brands in the whole world. It's in the consumer staples sector. It's done fairly well for me. I'm very happy with it. It's made me $159.97. It's up 18.9%, and it makes just over 3% of my portfolio. Coca-Cola is just it to me. It's just that steady stock that I can always be dependent on to just be a steady growth, probably low growth stock and pay me those dividends, and it's a forever hold for me. I do think they have some exciting things in their pipeline, which I've put in previous videos, but they are going to set themselves up to really compete with the likes of Pepsi. So I'm actually pretty bullish on Coca-Cola, and it's done well. 18.9% growth is very healthy. Then we have DuPont. Now, DuPont is in the materials sector, and this one has done well. It's up. It's made me $180. It's up 59.08%, and it's only 1.47% of my portfolio. It's one that I did research on earlier on, and they do a lot with like chemicals, and they have a very broad range of, within their business of what they do. So I really think this is a long-term hold for me, and I'll just keep my eye on this to see if any fundamentals change. But I really like this as my materials play. So now we're going to be diving into some ETFs I hold. What I have done is I found an ETF for each sector of the market, and this is because sometimes, I don't know a lot about certain sectors, so the safest thing I thought to do is put money into an ETF. Now, these are all Fidelity ETFs. I really like them. They have low expense ratios, and they've all done fairly very well for me. So let's get with the first two. The first one is an energy ETF. Its ticker symbol is FENI. So it's in the energy sector, of course, has like Chevron, ExxonMobil, a bunch of those guys in there. It's made me $143.35. It's up 25.14%, and it's 2.17% of my portfolio. So it's a little bit on the lower side of my holdings, but I think the energy sector is, one that we're very dependent on oil still. So I don't see that changing for a long time. But even with the change, these companies will adapt. So I'm very content holding this one. The next one is a healthcare ETF. Its ticker is FHLC. It's in the healthcare sector, obviously. This one is made me $76.51. It's up 18.93%, and it's a smaller holding. It makes up 1.46% of my portfolio, but that's because I have some other big healthcare holdings. So this one I didn't put much money into. The next two, I have an industrials ETF. Its ticker is FIDU. And so this one has made me $130.34. It's up almost 20%, and it makes up 2.39% of my portfolio. The next one is in the materials sector. That's FMAT, and this one is up $145.44. It's pretty much mirrors the industrial sector ETF. It's up 19.12%. It makes up 2.76% of my portfolio. Then we're moving on to a financials ETF. FNCL is the ticker symbol. It's up $246.20. It's up a very healthy 28.23%. You remember Bank of America has really delivered for me. So I'm glad to see this one reflective, decently, because it's a basket of stocks. So not all the, this is a good thing to look at, right? Sometimes those individual stocks are going to be where you have the more opportunity, where the ETFs are the safer bet. So you see the difference there where Bank of America, I've grown 71% versus this ETF of 28%. But I have a lot more risk holding one company than I do an ETF. So this one's 3.4% of my portfolio. The next one is a real estate ETF. It's FREL as the ticker symbol. It's up $139.36 and it's grown 33.49%. So very healthy, but it only makes up 1.69% of my portfolio. That's because I have a lot of money in individual REIT stocks, which we'll go over here shortly. And then the last ETF that is kind of divided out by a sector is utilities, and that ticker symbol is FUTY. Now that is up $166.76. It's grown 19.57% and it's 3.1% of my portfolio. Utilities are kind of more of that steady hold. You know, they're not going to be so volatile. They're going to kind of be that dependable sector that you can hold on to. So what I want you to see is all these ETFs has done well for me, right? They're all up a decent amount and it's a safe bet because you're putting your money into a basket of stocks instead of individual. So that's what I did is I just picked these ETFs for each sector of the market, and it's done very well for me and provides me a safety net. The next one is it's FNB Corporation, and it's in the financial sectors. It's a bank, and it's up $101.97. It's grown 34.18%, and it's only 1.22% my portfolio. I've done some, when early on I did some analysis on this company, and I thought I'd add it as a small play, and it's done really well for me. So I plan on keeping it still. And then the next two is good old Home Depot. It's in the consumer discretionary sector. This one has been excellent for me. It's up $559.76. It's grown 50.87%, and it makes up 5.05% of my portfolio. This is a long-term hold for me. I love Home Depot, and so I hope I get some opportunities to add on some dips. The next one is a newer holding. It's Meta Platforms, formerly known as Facebook. It's in the technology sector. And since it's newer, it hasn't had much time to really grow or do much, but it's still done well. So it's up $81.75. That's 5.11% growth, and it makes up 5.12% of my portfolio. I'm very bullish on Facebook due to their massive user base and their early adoption of the metaverse. Now the next two is Johnson & Johnson, which is the healthcare sector, and this one is up $244.66. It's grown 12.36% and it makes up 6.77% of my portfolio. I am bullish on Johnson & Johnson, especially because they announced they're spinning off a portion of their business. I've done a video on this. Feel free to check that out. And so I think their future is going to be more on the growth side instead of the steady dividend payer. And then after that, we have the monster, Microsoft. Now, this is in the technology sector. I am up $1,428.06. It's grown 54.79%. Now, Microsoft screams quality to me. In every way you look at this company, is just a beast and it reflects in its growth. Now, as I said, I never want to hold one company above 10%, so I broke the rule here. I'm at 12.28%. And so what I'm going to be doing is kind of adding to other stocks to level this one back down to 10%. Unless if there's a dip, I'm not going to hesitate to buy because it is a quality stock. But this is one that I'll probably slow some buying on because I want it to stay closer to that 10%. But it's been an awesome stock, definitely a long-term hold, probably a forever hold. Next up, we have Realty Income Corporation, the popular REIT. It's in the real estate sector. This one is up $385.80. It's grown 21.9% and it makes up 6.53% of my portfolio. I think Realty Income is a high quality REIT, and I think they're going to have some decent growth, maybe not big growth, but this one's just I think a reliable REIT that pays a great dividend. Now next one I have an ETF. It's the Schwab US Dividend Equity ETF. SCHD is the ticker symbol. I think many dividend, stock, investors know this stock, And so I didn't really put a sector definition other than dividend equity, but this one has grown $619.20. It's up 27.03%, and it makes up on the higher end, it's 8.85% of my portfolio. Now I like this one to stay at the higher end because I love how this has a low expense ratio, it pays out a very healthy dividend, and it has good quality companies in its ETF. In all of these ETFs, just look up the ticker symbols, look up the top 10 holdings, and you'll be able to see more or less if this is an ETF you'd like to hold based on the companies. But I love this one. I will keep adding to this regularly and have no plans to get rid of it. Next up, we have Starwood Property Trust. This is a real estate, a REIT company in the real estate sector. It's grown $95.40. It's up 27.89%, but it is only 1.33% of my portfolio. This was an early adopter of mine. I do like this. I've done my research on it, and so I think this will be a long-term hold for me. Next up, we have another controversial one, more of a cult stock, but that's Tattooed Chef. This is a plant-based food company. It's in the consumer staples sector. Now, this one is at a loss right now of $103.24, so it's down 10.28%. It makes up a small portion of my portfolio at 2.74%. I really think this will turn around in 2022. I think I will be in the green by the end of by this time next year when I do another update on my portfolio. So I'm very bullish on this. I think the whole, you know, plant-based food diet thing craze is going to keep on going and will not die down. And so I'm very bullish on Tattooed Chef and like its business model. Now, the last three, we have the good old AbbVie. This is a very popular dividend paying stock. It pays a very healthy dividend. It's in the healthcare sector, and it's into the pharmaceuticals and things like that. But it's gained me $402.75. It's up almost 50% in the growth, and it's 3.71% of my portfolio. I like AbbVie. It's been a very good play for me. It's gone up quite a bit, so I don't think I'll add any more at this point unless it has a very, very healthy dip. But I will hold on to this one. It's just a good steady holder, and it pays me a good dividend, and I really like AbbVie. Now, the next one is a newer holding as well, but I've been very bullish. So I put a decent amount of money in it, and that's Vici Properties. It's an experiential REIT in the real estate sector. I am up $50.88, so that's 3.29%. And this one has been hit hard by the pandemic, and it's a newer holding, so I don't expect this to be like some 10% or more growth at this point, but it does make up a healthy 4.85% of my portfolio. I am extremely bullish on Vici, especially over the next decade or two. This will be one of my top holdings, and I pretty much guarantee next year this will be more like 6% of my portfolio. Last but not least is I wanted some international exposure, so I got a Vanguard International Stock ETF, and its ticker symbol is VXUS. It has a lot of holdings, so it's very, to me, diversified and safe. So I've made $139. It's up 12.27%, and it makes up 3.87% of my portfolio. I do think that international companies have a chance to really do well in 2022. So I think I'll add some money early on in this first quarter to this ETF and then just kind of let it ride the rest of the year. So that's my plan. And that sums up all my stocks, all my holdings, ETFs, whatever they may be. So now to kind of reveal the grand total of my whole portfolio, let's reveal that in 3, 2, 1. So this portfolio has made me $6,210. I'm up 23.29%, which I am extremely happy about. To me, that is a successful portfolio. And I think, you know, being diversified, investing in quality companies, it pays off. And here's the proof. A lot of people want to invest in those speculative or SPAC stocks or penny stocks or, you know, uh, very little known companies that you see on Reddit that people are like, buy, it's going to go up. And I can almost guarantee you 95 to 99% of those people, if you look at their portfolios, I bet you they're in the red or have grown nowhere near what this portfolio has grown. And I contribute my growth to sticking to diversification and quality stocks and making sure that, my portfolio allocation is weighted in a healthy way based on what's going on in the world around me at the time. And so I'm very proud of myself, and I hope to continue this success. And so we'll see what 20 and 22 brings. But before we do that, let's look at a few charts. I wanted to kind of show a chart based on my gain and loss per sector. So you can really see that the technology sector has outperformed big time. Now, this is a no surprise, right, to any of us because tech stocks have really delivered the last 2 years. Telecommunications, of course, is my big loss, but that's AT&T, and T, and I don't need to tell much there. And I did a video on it why I'm bullish, but AT&T has been devastated for many years now, but I think it'll start to turn around finally. Other kind of better plays have been healthcare, real estate, consumer discretionary, and then my dividend ETF, the SCHD Schwab ETF. So I think this really reflects the market, and I think that's why you want to be diversified. Um, and I'm just very, very excited to keep adding to this portfolio in a very logical manner, right? A way that will ensure I am protected, but also taking advantage of profit. So now we're going to get into dividends. So this graph here that I'm showing you is not what I've earned, but what I expect to earn every year based on these stocks and their dividend yield and what they pay out. So you'll see I'm very heavy in real estate as far as receiving dividends, but that makes sense because REITs usually pay by law they pay out a certain percentage of earnings to back to shareholders. So that makes sense. Telecommunications is AT&T. They pay a very huge dividend right now, which is going to be cut in half. So I am preparing for that. And then technology, I have a lot of money in, so that makes sense. And then my Schwab dividend equity, that makes sense because that is a dividend ETF. So I just kind of want to show you the breakout between all the sectors. So let's look at the dividends. This is, I think, what a lot of people have been waiting for. So last year, you'll see I made a total of $330.50. My goal was to at least double that, and I beat that. I made almost $760 in dividends this year. So between the 2 years, I made $1,090 in dividends. What I want you to see and kind of take from this is that snowball effect, right? You invest in these quality companies that pay dividends and grow those dividends each year, and you reinvest them. And what that does is it grows your dividend income. And that's the goal, is to not just depend on one source of income, but a second source of income and keep on going, seeing if I can create other sources of income for myself. Because if you just depend on one source of income, that's very risky. And if you lose that one job that brings you the income, that's going to be devastating. So my goal is to get this up to a healthy point where if I had to survive based on my expenses off my dividends, I could. So I'm excited to share this journey with you and each year how these dividends grow. Now, I just did a brief chart to compare the 2 years just to show the growth year over year. Of course, most companies pay quarterly on the March, June, September, and December dates. So that's why those are the peaks. But every month I made more than the previous month last year. And so that just shows the power of these quality companies, how they, usually annually increase their dividend payout. And it's a great thing. And again, it's that snowball effect that occurs that is very important. And that's I think a big part of investing is you can't really use those dividends unless you really need to. It's good to reinvest them. So that was a lot, right? Revealing every single holding in my portfolio, showing you guys my dividends that I've earned last year, this year, and the comparison and the total. And again, I just contributed to sticking to the basics of investing. It's not sexy, and a lot of people want to follow those people that are very risky, but it really results in losing money. And it's a sad thing to see because we work hard for our money and we have to make it work hard for us in return. And that's what I'm doing. And you saw that almost, 23 point whatever percent growth in my portfolio. The dividends I've earned, it's working, and it's hard to see it in the beginning, but now at year two it's like the snowball effect is starting to really get more obvious. And so what's my plan going into 2022? Well, it's not going to change from the plan in 2021, I'm going to still buy regularly every paycheck. I'm going to buy quality companies. I'm going to buy, now, if there is like a 5% dip or more, I'll buy a little extra. I think that's a good thing because when things are on sale, pick up a little bit more. And then staying diversified. So analyzing my portfolio regularly and making sure I'm diversified for protection, right? That's kind of the insurance for your portfolio is being diversified. And we get insurance for everything else, right? And those rainy days when they do happen, that insurance kicks in and helps us. That's what diversifying your portfolio does for you with your investments. So I'm excited to, next year hopefully see what happens with AT&T. That's my biggest loss. Cat2 Chef I think will turn around. And then my big players like Microsoft I think will continue to do extremely well. But I want to bring that, portfolio allocation from that 12.28% closer down to 10% because I got to stick to, my rules. But I'm not also going to be stuck with, if there's a good buying opportunity, not buying because it is a quality company, and then I can really focus in on increasing other areas and kind of bringing that one down over time. So there you guys have it. This was big for me to be this transparent, and so I really appreciate you guys watching and hopefully you subscribe to this channel because this is a journey that I'm taking you guys on. I'm always gonna this is a channel, this finance and fitness channel is all about growing, right? So growing and improving in our fitness, growing and improving in our financials, whether that's investing or through our, reducing expenses. I'm always going to be very diverse in what videos I put out. So you're going to get a lot on this channel, and you're also going to get to see my portfolio, time and time again and how it's performing because I want to be transparent. I think that's very key, and there's some YouTubers I follow that do that, and I really do appreciate it. So I want to give that to you guys. So with that said, guys, I'd love to hear your opinion on this portfolio. Also, if you guys feel free to share your performance of your portfolio in the comments, just kind of, you don't even have to give details, just say I did well, I didn't do well, and maybe why. And do you stick to more of the non-sexy way of investing and how have you done? Or did you take a chance and did you do well or did you not? So I'd love to hear some feedback on this, on your portfolios, on my portfolio. Thank you guys so much. This was a big video I put out. And so I hope you guys have a great rest of the day. We'll see you very soon and Happy New Year as well. But we'll see you very soon on Mark's Finance and Fitness.